Something you may have noticed about the Measure Twice brand is that the slogan is Keep Finance Personal. I have realized that most personal finance content focuses on rules of thumb and one-size-fits-all advice, often assuming that every consumer is on the same path to and through traditional retirement with equal access to various retirement accounts. One of the ways you can keep finance personal on the technical side of planning is by understanding your specific retirement savings options, and each spouse or partner may also have respective access to various retirement vehicles. Starting off, most workers' earnings are subject to a mandatory Social Security tax, which funds multiple insurance programs, including retirement, survivors, and disability benefits. The following video will share how to read your Social Security statement and estimate your future benefit amounts. Other forms of retirement savings with contributions out of your control may include mandatory employee and/or employer-funded benefit plans, such as the Federal Employees Retirement System, union pension funds, private pensions, and public retirement systems that may even replace Social Security benefits. Each retirement program involves unique contribution, vesting, diversification, and retirement income distribution options. As you create your one-page summary in a moment, you may want to clarify the plan's details, often found within the summary plan description or online. Speaking of, additional tax-deferred retirement plans that are primarily employee-funded may include 401ks, the Thrift Savings Plan (TSP) for those federal employees, 403bs, tax-exempt or governmental 457bs, and simple IRAs. Although they have multiple names and different contribution limits, they can actually be fairly similar. Employee or employer-funded equity plans may also be available as an alternate form of compensation, including stock options, restricted stock units, employee stock purchase plans (ESPP), and employee stock ownership plans (ESOP). If you own your company's stock, be careful about concentrated stock positions that lack diversification, especially when directly tied to your current employment. Unsystematic falling stock prices often align with mass layoffs. And an added note, make sure to learn more about the tax consequences of various types of equity compensation. Separate from the employer-sponsored plans, traditional and Roth IRA contributions both require earned income as a household, keeping in mind that traditional IRA contributions do not have maximum income thresholds, but they do have deductibility limits based on household coverage by workplace retirement plans. More IRA details are linked below. Roth IRAs, including the backdoor option, may also be available, with careful analysis of income thresholds and possible pro rata taxation. You may rewatch the Roth IRA lesson for a refresher on how all that works. Health savings accounts, HSAs, may be available as a powerful retirement plan supplement with coverage by a high-deductible health plan, HDHP. And finally, my favorite and most undervalued retirement savings vehicle, the normal taxable brokerage account, which provides incredible cash flow flexibility, favorable tax treatment, and no contribution limits. I encourage you to create a one-page summary listing your respective savings options before prioritizing your accumulation or distribution order of operations or implementing any desired strategies. Here is just one example, and yours may look very different.